Welcome to the blueprint for growing your money, even if you feel nervous about investing. First, since you already keep debt low and save a lot, you're ahead of most people. However, leaving large amounts of cash in a regular savings account quietly loses purchasing power to inflation. In this video, we'll show a practical system that protects your short-term needs while putting your long-term money to work. We'll start with a quick agenda, then cover the safe cash strategy, a simple long-term investment plan, the golden rules, and a couple of quick quizzes to lock it in. Let's begin. Here's what we'll cover. First, we'll explain why holding too much cash in a standard account is risky due to inflation. Next, we'll walk through a safe, higher yield approach for money you might need within 3 years. Then, we'll switch to a simple, long-term investing plan for goals 10 or more years away. After that, we'll discuss Roth IRAs and low-cost index funds. We'll wrap up with golden rules and 2 quick quizzes. With that roadmap in mind, let's add a brief disclaimer to set expectations. Before we proceed, a quick disclaimer. This content is for education only and not individualized financial advice. Everyone's circumstances differ, particularly regarding taxes, risk tolerance, timelines, and account options. Please perform your own research and consider speaking with a qualified, fiduciary financial advisor or tax professional before making major decisions. With that in place, let's transition to why cash hoarding can quietly erode your wealth. Let's talk about inflation. When your savings account pays near zero interest while prices for essentials rise several percent per year, your money loses real purchasing power. That means the same dollars buy less over time. Consequently, hoarding cash in a standard checking or low-rate savings account is a losing strategy for large balances. However, we don't want to gamble either. Instead, we'll use safe, insured vehicles that still keep your cash flexible for near-term needs. With that understanding, let's outline your strong foundation and how to allocate your savings more intentionally. Your strongest advantage is behavioral. You keep debt low and maintain a very high savings rate, potentially 70% or more. That combination creates flexibility and safety. Next, clearly segment your money by time frame. Reserve funds for immediate needs. Set aside short-term cash for the next 0 to 3 years, and allocate long-term money for 10 years or more. This simple framing prevents mixing rent money with retirement money. Now that we've reinforced your base, let's move into the safe, higher yield approach for short-term cash so it stops collecting dust. For money you might need within the next 3 years, do not invest it in the stock market. Instead, place it in a high-yield savings account or short-term certificates of deposit. HYSAs are flexible and often pay far more than standard checking. CDs can offer slightly higher yields in exchange for locking funds for a set term. Make sure your balances remain within FDIC or NCUA insurance limits for safety. This short-term bucket acts as liquidity insurance for emergencies, moves, or life transitions. With your short-term cash protected and productive, let's visualize how all your buckets fit together. This flowchart illustrates the 3-bucket system. Income flows first toward immediate needs in your checking account for bills and everyday spending. Next, a portion is allocated to the short-term bucket, your high-yield savings account or short-term CDs, covering 0 to 3 years of planned expenses and emergencies. Finally, the largest share for long-term goals goes into your Roth IRA, invested in low-cost, broad market index funds. The example percentages are just placeholders. You'll adjust them based on your priorities, upcoming expenses, and risk comfort. With the big picture in mind, let's turn to the long-term investing approach that is intentionally boring yet historically effective. Long-term investing should be boring and repeatable. Start by learning from free resources at major brokerages such as Fidelity, Vanguard, or Schwab. Next, open a Roth IRA if you're eligible so your contributions can grow tax-free over the decades. Inside the Roth IRA, select low-cost, diversified index funds, or ETFs that track the total market, or the S&P 500. These funds spread your risk across many companies and historically outperform most active strategies over long horizons. Then, automate contributions, occasionally rebalance, and tune out short-term noise. With the concept clear, let's walk through opening and funding a Roth IRA step by step. Here's a simple sequence. First, verify Roth IRA eligibility and annual contribution limits for your tax year. Second, choose a reputable brokerage that offers low fees and easy automation. Third, complete the online application to open your Roth IRA. Fourth, link your checking account and set up automatic transfers, ideally aligned with your pay schedule. Fifth, select a core low-cost index fund or ETF, such as a total market fund within the Roth IRA. Finally, establish a recurring contribution plan and let the system run. Now that the setup is clear, let's compare the order of priorities so you contribute in a smart sequence. This timeline lays out a sensible progression. First, eliminate high-interest debt because it compounds against you faster than most investments can grow. Second, build an emergency fund in a high-yield savings account to handle surprises without using credit cards. Third, make Roth IRA contributions up to your limit to capture tax-free growth potential. In parallel, if your employer offers a 401k match, contribute enough to secure the full match. It's effectively free money. Finally, once those bases are covered, invest additional funds in a taxable brokerage account using low-cost index funds. With priorities clarified, let's check your understanding with a quick quiz. Question 1. Where should you keep money you'll likely need within the next 2 years? Option A, in a high-yield savings account or short-term CDs. Option B, in a volatile meme stock. Option C, in a long-duration bond fund. Option D, under the mattress. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is, in a high-yield savings account or short-term CDs. Short-term funds should prioritize safety and liquidity while still earning better interest than a standard checking account. Stocks or long-duration bonds can be volatile, and keeping cash at home adds risk without yield. Now let's deepen your investing knowledge with one more quick question. Question 2. Which is the best fit for investing money you won't need for 10 or more years? Option A, a low-cost total market ETF inside a Roth IRA. Option B, a single hot stock a friend recommended. Option C, a high-yield savings account paying around 4%. Option D, gold bars stored at home. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is a low-cost total market ETF inside a Roth IRA. Over long periods, diversified index funds have historically performed well, and holding them in a Roth IRA allows potential tax-free growth. Concentrated bets, cash accounts, or physical commodities don't match the risk-adjusted return profile for a multi-decade plan. Next, to reinforce the cash strategy, let's compare HYSAs and CDs side by side, and also discuss the trade-off between paying off debt and investing. On the left, paying off high-interest debt is a priority because the interest you avoid is a risk-free, guaranteed return. Removing expensive debt also lowers stress and increases cash flow resilience. On the right, investing while carrying high-interest debt often backfires, since market returns are uncertain and may not exceed the interest you owe. By handling debt first, you stabilize your finances and set a stronger base for long-term investing. Now, let's examine how HYSAs differ from CDs so you can pick the right tool for your short-term goals. This table highlights the key differences. HYSAs typically offer variable rates and easy access to funds, making them ideal for emergency reserves or uncertain timelines. CDs usually provide fixed rates for a defined term, potentially paying more in exchange for reduced liquidity. Early withdrawals from CDs may trigger penalties, so they're best when you have a known date for using the money. Both can be insured within FDIC or NCUA limits, reinforcing safety. With the cash tools clear, let's visualize the overall risk ladder from cash to equities. This state diagram shows a simple risk ladder. On the left, cash in HYSAs or CDs offers high liquidity and principal safety but limited return. In the middle, bonds generally introduce moderate risk with moderate expected returns. On the right, broad equity index funds carry higher volatility, yet historically offer higher long-term return potential. As you move from left to right, both risk and expected return increase, and the appropriate time horizon lengthens. With the spectrum in mind, let's cement the most important behavior rules that keep this strategy working over time. Here are the golden rules. First, avoid high-interest debt because it undermines progress. Second, prioritize tax-advantaged accounts like the Roth IRA to capture tax-free growth. Third, commit to a long-term mindset and resist panic selling during market declines. Finally, be patient and consistent. Automation reduces reliance on willpower and keeps contributions on schedule. With the core rules summarized, let's quickly recap the entire blueprint so you can take confident next steps. To wrap up, segment your money by time frame so you never confuse short-term needs with long-term goals. Place 0 to 3 year cash in high-yield savings accounts or short-term CDs for safety and better yield. For 10-plus year goals, use a Roth IRA if eligible and invest in low-cost, diversified index funds. Follow the golden rules, automate contributions, and keep expanding your knowledge through free resources from major brokerages. Finally, let's close with a quick thank you and a creative call to action. Thanks for watching and investing in your financial education. If this video clarified your next steps, please like it, share it with someone who needs a plan, and subscribe for more practical, no-hype money guides. In the comments, tell us your next move: opening HYSA, funding a Roth IRA, or automating contributions. Your questions might shape a future deep dive. See you in the next one.